All right, here we are again, almost towards the end, aren't we? We have this lecture and then next lecture, and that's it, isn't it? Okay. So I believe I assigned a couple of Chapter 11, two or three Chapter 11 problems, and let's go ahead and go through those. I'm going to go through the quick studies. I'm going to hold off on that exercise I assigned, but let's go through quick study 11.2 and 11.3 real quick, okay? And I don't think these were too tough. Did you guys have trouble with these? Not too bad. Quick study 11.2. Tickets Inc. received $7.5 million cash in advance ticket sales for a 5-day tour of Bruce Springsteen. Record the advance ticket sales on October 31. Record the revenue earned for the first concert date of November 5th, assuming it represents 1/5 of the advance ticket sales. This example kind of hits home to me. So, because remember when Bruce Springsteen was in town about a month ago? It was about this exact date. I had tickets from a friend of mine, and we had the, did I tell you this? No. We had the VIP tickets, which was free drinks, free food, third row, everything, going to Bruce Springsteen. And we got there and they canceled that concert like an hour and a half before. Yeah, there was a death of one of the concert roadies or something like that. So it was a real bummer. It was, I mean, an hour before we were all hyped up. So Bruce, if you're watching this accounting lecture somewhere out there, you need to come back to Kansas City and do what's right. This also, so this Tickets Inc. This Tickets Inc. is like Ticketmaster or something, isn't it? You like Ticketmaster, guys? I hate Ticketmaster. Ticketmaster, if you're watching this, you guys are an evil corporation, right? They charge you way too much for their service fees, don't they? Okay. So we have Tickets Inc. received $7.5 million cash in advance for the 5-date tour of Springsteen. Okay, first of all, they want us to record the advance ticket sales on October 31st. Okay? So let's do that. Now, we cannot book this, and we've talked about this before. This is kind of review. There you go. We cannot book that as revenue because we need to acknowledge the revenue recognition principle, which states that we recognize revenue when it is earned. When is it earned? When we have provided the product or the service. Correct? Correct. Okay. And we haven't provided any concerts yet, have we? Now, it goes on to say that that on November 5th, we had the first concert date of those 5-date tours. So it's 1/5 of the advance ticket sales. So 1/5 of $7.5 million is $1.5 million. We can debit or reduce that unearned ticket revenue liability, and we can book it into revenue. Okay. Now, if you just said revenue, that's fine. Okay. But we can reduce that liability because we have satisfied $1.5 million of that current liability. Does that make sense? Okay. That one's not too bad, is it? Okay. All right, let's go on to quick study 11.3. Wheeling Computing sells merchandise for $12,000 cash on September 30th. The cost of the merchandise is $7,800. The sales tax law requires Wheeling to collect 6% sales tax on every dollar merchandise sold. Record the entry for the $12,000 sale and its applicable sales tax. And then also record the entry that shows the remittance of the 6% tax on this sale to the state government on October the 15th. Okay. All right, first of all, think of it this way. Somebody comes and buys merchandise, and the sale is for $12,000. Well, like I said the other day, if you go buy a DVD at Best Buy for $20, you know you're going to end up handing them more than $20, right? You're going to actually have to give them the sales tax as well. Now, here is the sales tax of 6%. So this cash represents 6% of the $12,000 plus the $12,000, right? Now we need to record the cost of goods sold as well, which they told us. We decrease our inventory and we book it as cost of goods sold. So those are the two entries that we make on September 30th the date of the sale. Okay? Now we owe the state government $720, don't we? Do they care that we pay that to them? Yes, they do. Do they care that we pay that to them on a timely basis? Yes, they do. Okay? So on October 15th, we pay out that money, and that short-term or current liability of sales tax payable is reduced. Okay? So that was Quick Study 11.3. Not too tough, is it? Okay? Alrighty. Okay, I'm not gonna go over exercise 11.1 right now. I'm gonna actually jump over to the lecture. I want to make sure we finish the lecture for chapter 11 today, and next period, if we have just homework to go through, that kind of works better. Okay, so I want to make sure we get through the lecture today, and then I'll give you your chapter 11 homework. And then next class period, which would be the last one, the game plan is to go through that homework that I assigned, talk a little bit about the final. You present me a class gift, and then we hug and we say goodbye. Okay? I'm just kidding. Okay? Let's talk about where we left off on chapter 11. And I believe we stopped right before short-term notes payable. Is that correct? Is that right? Anybody verify that? Okay, is that right, guys? Do you remember that? It seems a long time ago, I know. Short-term note payable, it's kind of the flip side of short-term receivables, which we learned about a few chapters ago. It's a written promise to pay a specified amount on a definite future date within a year. You can just think of it within a year. Okay, this is a short-term or current note payable. Okay, here is an example of a note given to extend credit. Here's the deal. In this situation here, we are Matrix, okay, and we have a $5,000 account payable to Carter. Okay, now we're Matrix. For whatever reason, maybe we're short on cash, maybe the economy is bad, we can't pay that 5,000 accounts payable right now. So we ask, as Matrix, we ask Carter if they'll accept a 90-day 12% note payable to replace that. And there's going to be 12% annual interest attached to that, and they're happy to do that. Having a note, we have a note payable, they have a note receivable. That's a little bit more of a solid piece of evidence that they're owed that money, plus they're going to earn some interest. So we take that accounts payable off the book by debiting it, and we replace it with a note payable to Carter for the $5,000. Okay? And it's a 90-day note. Now on October the 30th, we pay the note plus interest. Now going back a slide, do we just have to give them $5,000 when we pay this off? No, we have to give them $5,000 plus $150 of interest expense. Okay, how do we get that $150? You take that $5,000 times the annual rate of 12% times 90 divided by 360, since this is a 90-day note, right? And we do 360 as opposed to 365 just because it usually gives us a little cleaner numbers. But we've gone through that before, haven't we, on the notes receivable side? Okay. Here's what the note looks like. We've kind of seen that. It's signed by the person who owes the money. It says exactly what has to happen when, what the interest rates are. Okay. Now we are talking mainly about, really only about note payables when the face value equals the amount borrowed. In other words, where in this case, let's read it, and I'll tell you. On September 1 of 2008, Jackson Smith borrows $20,000 from American Bank. Okay? Now this is a little different situation. This is not a note payable that's put in place in order to replace an existing accounts payable. Okay? This is like a loan. So on September 1 of 2008, Jackson Smith borrows $20,000 from American Bank. The note bears interest at 6% per year. Principal and interest are due in 90 days. Okay. The face value equals the amount borrowed. That means the amount that we actually borrowed is $20,000. That's the principal that needs to be repaid. That's the only type we'll talk about, is when the face value equals the amount borrowed. So it's not a whole lot different from the other situation. We credit or create that notes payable that's due in 90 days, and this is a loan situation, okay? So we debit cash. Now on November 30, we make the following entry. We don't just have to pay back the $20,000 principal, but we have to pay back the interest as well, and it's computed in the same exact manner as we computed interest in the prior example. Okay? Questions on that? Now, and we talked about this, I believe, in the chapter on receivables as well, but if there is an end of period date that falls in between when we created the note and when we have to pay off the note, then we have to do an AJE to record the interest expense that's been incurred, and we have to record an interest payable liability. Now, we don't have to pay it on that date, but we need to show the readers of our financial statements that, yes, there is a liability. And we need to make sure that that expense gets booked in the proper period. Okay? For instance, James Burrows borrowed $8,000 on December 16th, 2008 by signing a 12% 60-day note payable. Okay? Well, this is the date that he borrowed the money, and this is our financial statement date, right? This is when we release our financial statements. So as of that December 31 of 2008, James Burrows owes some interest. He doesn't have to pay it that date, but they need to show the interest that is payable at that date. How many days have gone by in between these 2 days? 15 days, right? Kind of messy. Okay? So, first of all, on December 16th, he makes that entry. But then the AJE at the end of the year, he takes the principal of the note times the annual rate times 15 over 360, because 15 days have gone by between that date and that date. Okay? Now on a test or something, if you count 16 days or 14 days, not a big deal. If it's a multiple choice situation, then just the answer should be there. You know, pick the one that's closest to whatever you computed. Okay? Now, of course, we don't have to pay interest on that date, but then when he does finally have to make the following, when he has to pay off the note, this is the entry. And I guess the way I always create this entry is this, is I ask myself, what's the total amount of interest that he is going to have to pay on this note? And that would be 8,000 times 12% times, and what was it, what long length of note was it, a 60-day? Times 60 over 360. That would equal 160, right? So he has to give principal of 8,000 plus total interest of 160. Then I take the note payable off my book. Then I ask myself, of that 160, how much of that has not yet been recognized as interest expense? And in this case, the answer is 120. And then the plug to make that journal entry balance as a check figure needs to be the amount of liability that you're reducing, that you recorded in the AJE at December 31 of 2008. Does that make sense? I think we've gone through this before. All right, let's talk about some other stuff. Payroll liabilities. Okay? If you have your own business and you have employees, you get the privilege of paying a lot of expenses for those employees, right? This is a very hot topic right now, isn't it? As we talk about health care plans and all this sort of stuff, okay? Now, first of all, now we talked about, this is employers, right? Employers incur expenses and liabilities from having employees. Now let's talk about employees. How many of you work somewhere? Raise your hand, okay? All right. Have you noticed that your gross pay and your net pay is a lot different numbers? Yeah, it is, isn't it? Okay? Let's say you work 40 hours a week and you get paid $10 an hour, so you earn $400 gross pay. Your check's not going to be for $400, is it? It's going to be, going back to the slide, all of these differences between gross pay and net pay. Okay? First of all, here's the big one right here, this guy right here. FICA taxes. What's another word for FICA? Social Security. Okay? You've got to give some of your money so this nice old couple can continue to go to Cabo every summer, right? I'm sorry, that's a little editorial comment. Okay? Even though this guy made $200,000 a year for his entire career, right? There's also a part of Social Security that is Medicare. Okay? Now, of course, you have to pay your federal taxes, your state income taxes, and some places, KCMO is one of those, you even have local income taxes, right? And then you might have voluntary deductions for like union fees or health benefits, or there could be a number of different other deductions that you have voluntarily deducted. Huh?
Investments.
Yeah, investments. Maybe you have something in the 401k or the company investment plan. Or maybe some companies even have like a health care plan that you can have some deducted and go to a health club or something like that. Okay? So there's a big difference between your gross pay and your net pay. Okay? Now let's take a look at the next slide. Listen to me carefully, okay? I am not going to make you compute payroll expenses. I'm not going to make you compute how much Medicare would be due payable. How much, I'm not going to make you do that. I'm not going to make you say how much unemployment would be, all that sort of stuff. Okay? These percentages are up here. You do not have to memorize those percentages. Okay? Now, you don't realize how much you should be thanking me right now, but you should be thanking me. Okay? Because that's kind of a pain in the bobo. All right? But those percentages will change, and there's different maxes that come into play. All right? You're not going to have to compute those. I want you to get the general idea, the general concept of this, but I'm not going to make you on the test compute how much would go to Medicare, how much would go to Social Security. Okay? And then, of course, this is the subject of the chapter on current liabilities. This money that the employer withholds, they're the one who remits that to the IRS or to the appropriate parties, correct? So those are liabilities on their book, correct? Okay, this talks about employee income tax. Again, you know this whole drill. Money gets withheld from your check, and the employer has to pay that to the appropriate government agency. Okay? There's voluntary deductions. We talked about some of these. Union dues, savings account, pension, insurance, charities, whatever. Okay? There's a program at JCCC where you can give a percentage of your salary to United Way if you want. That would be a voluntary deduction. But then JCCC would have a current liability, and who would they need to pay? United Way, right? Basic premise here is that all of these deductions, whether they're voluntary or mandatory, that are withheld, the employer needs to make sure they remit those monies to the appropriate parties. And until they do, there's a liability on the books. And almost always it's a current liability because it's going to be due within the next year for sure. All right. This is employer taxes. Now, not only do you have to pay FICA and Medicare, but the employer also has to pay FICA and Medicare, right? You with me? So if in a certain paycheck, Zach, if you had $90 withheld for FICA and for Medicare, not only does that $90 go to the Medicare or FICA, but the employer also has to pay $90. You see what I'm saying? So a total of $180. Okay? That's a lot of money, isn't it? But going back to the slide, both parties have to pay that money. Now, if you have your own business, you have to pay both sides of it, don't you? Has anybody ever been in that situation? You have to not only put, if you have your own business, you have to pay, they call it a self-employment tax, okay? You have to pay it because you're kind of the employee and the employer. It's a lot of money, isn't it? But, let's face it, this couple right here, they need the money, right? Because they're going to Cabo all summer long, right? Okay, we're going to edit all that out. Okay, the other thing that employers have to pay, not employees, but employers, they have to pay unemployment taxes, okay? They need to pay into a pool of unemployment taxes. Have you ever had to ever gone on unemployment? You get some money. Well, where does that money come from? It comes from the unemployment taxes that employers have paid in, okay? So, employers set up these liabilities in regards to their share of FICA and Medicare and their share of Fed and state unemployment, and until they pay those, then there is a current liability on the books, okay? Okay, there's also a slide here that's called multi-period known liabilities. That's kind of a confusing deal, the way that they have this on the slide. Basically, let's come off there and what they're talking about is you might have a liability on your books that a portion of that is due within the next year, but then a portion of that liability is actually due beyond the next year, okay? So it actually, part of it's current, part of it is long-term, okay? Let me give you the best example I can think of. Let's go to the Elmo here real quick. Let's say that you have a mortgage payable on the building that your company purchased, okay? So you have a mortgage payable. And let's say the total mortgage payable is $210,000, okay? That's the principal amount, okay? Well, maybe 10,000 of that principal is due within the next year, and the other 200 principal is due beyond the next year, okay? You with me? Well, this would be classified as current, and this would be classified as long-term or non-current. So this one mortgage payable would actually show up two different spots on your balance sheet. Make sense? And you can come off that now. That it could be that way with other liabilities as well, right? It could be that way with unearned revenues. Could be that way with notes payable, whatever. But again, the key distinction is take the portion that is due within the next year. That needs to go in the current liabilities, and the remainder of it will go in long-term liabilities. Cool? All right, we're booking through here. All right, last few subjects here, going back to the PowerPoints. There's also estimated liabilities. What is an estimated liability? An estimated liability, and I'm not going to ask you to write out this definition or anything, but it's a known obligation. You know you have to pay it, but it's an uncertain amount. But it can be reasonably estimated. Okay? So it is a liability. You know that you have this liability, but it's an uncertain amount. However, we can estimate it. Okay? An example would be vacation benefits. Okay? If you work at a place where people accrue vacation as they work, like sometimes it's like every month you work here, you get paid a day vacation. Well, that is a short-term liability that's going to be gradually accrued on the books, okay? And I'm not worried that you understand this little calculation that they show on this, but I just want you to understand the basic premise of, that vacation is a liability that a company could have. there's also a warranty liability. Now, a warranty liability, let's think about this. What is a warranty? A warranty is like if, let's say you buy a Ford truck and they offer a 5-year warranty, right? They know from their past history that they're going to have a certain warranty that they're going to have to satisfy. That might be through people they have to pay, labor that work at the mechanic shop, or parts that they have to put on that car or whatever, right, that you bought. So it's a known liability, but they don't know the exact amount. But they can reasonably estimate it, okay? But here's the deal, and this kind of goes back to when we were talking about bad debt expense, okay? Remember when we talked about bad debt expense, we said when we have receivables, we know from the history that some of those receivables won't be paid. We can estimate it, but we don't know exactly which ones, right? So we estimate it, but we estimate it also because we have to satisfy the matching principle. If the sale that created that receivable is booked in this period, then we need to estimate the expense so it's booked in the same period, correct? Remember that? It's the same way with warranties. When we make a sale of a new truck, if we're Ford Motor Company, we have to estimate the expense and get it matched in the same period, even if it's an estimate, okay? All right, so going back to the slides. Let's see if they give us an example. They do. How nice of them. A dealer sells a car for $32,000 on December 1, 07, with a warranty for parts and labor for 12 months or 12,000 miles. The dealership experiences an average warranty cost of 3% of the selling price of each car. And where do they get that 3%? That's just kind of from history what they've expected, right? So, what they would do is they would set up a liability. 3% of $32,000 is $960. They would debit warranty expense and they would credit estimated warranty liability. Okay? Now, this warranty is only for 12 months, correct? So it's all a current liability. All right? And so it is set up as follows. But notice that the sale of the car and this estimation of warranty expense are in the same period. So the matching principle is satisfied. Okay? Well, let's say then on February 15th of 08, a month and a half after you purchase this car, or 2.5 months, it already needs $450 worth of work. You got to feel good about that purchase, huh? Right? So how do we book that? Now, we're not the person with the car. We're the person that sold the car. Well, what we would do is there's $200 worth of parts, so we have to decrease our auto parts inventory. There's labor of $250, so we would either credit cash if we paid them right away, or we would credit salaries payable for the amount that we owe them. And then we reduce this liability that we set up, right? We reduce this liability, okay? Because we're partially satisfying that. It's a little bit like allowance for doubtful accounts, isn't it? Now, if it turns out that our warranty costs are a lot more than 3%, then we need to modify that, right? Or it could be that they're a lot less than 3%, and then we can modify it the other way. Understand? But that's the way you satisfy this current liability, is when you actually provide those warranty services, okay? And of course, one car may need a lot more warranty work than another. The 4% is kind of an average for everybody, right? Put together. All right, questions? Okay, let's talk about contingent liabilities. Now, a contingent liability is a potential obligation that depends on a future event that arises out of a past transaction or event. Let's take a look at an example. Might be a lawsuit. Okay? Maybe there was a situation that happened a while back, a past situation, and there is a current court case on the books. Now, the future event then would be depending on how the judge or the jury decides, in your favor or not in your favor. And if not in your favor, how much you have to owe. So do you see where this is? I mean, think of a company like Ford Motor Company. Think about how many lawsuits that they have at any given financial statement period, right? A lot of them, right? Okay. Well, what do we do with those? Well, we have to kind of go to this chart. First of all, we have to analyze the probability of a future sacrifice. If the probability is remote, we don't do anything. Okay? Now, what if the probability, what if it is very probable that we're going to have a future payment or a future sacrifice, and the amount can be estimated? Well, in that case, if it can be estimated and it is probable, then you are going to record the current liability. In other words, you are going to book the JE in your financial statements if it satisfies both of those conditions. It can be estimated and it is probable. You're going to book a JE. Okay? Now, in any other case, if it's reasonably possible or if it's probable but it cannot be estimated, you're not going to make a JE. You're not going to ignore it. What you are going to do is you're going to disclose it in the notes to the financial statements. It's been a while since we looked at notes to financial statements. But do you know what I'm talking about in that regard? If you look at the very end of your book, see if I can find an example real quick. Take a look at the very end of your book in those Best Buy. In the Best Buy financial statements that they give you at the very end of your book. We're talking about page like A1, A2, A3, A4, A5. Okay? The notes actually start on A8. Okay? A8. All right? And I can't find anything. I'm just looking at it now, but A8, A9, A10, A11, those are the notes. Those are telling you about the financial statements, okay? So there's a lot of times we won't book a JE, but we're going to put it in there, okay? And if you ever look at financial statements, if you ever look at a corporate annual report, actually the best place to start is the notes. Don't look at the financial statements. Read the notes first. Find out what the company is all about, how they do business, what the situation is. Then look at the P&L or the income statement, the balance sheet, the cash flow statement, statement equity. Okay? All right, going back to this slide that I marked all up. Any questions on that? Does that make sense? You can read about that a little bit in your book if you want. And that kind of is just a different way of explaining what we just did. I actually think this way is easier, especially when I mark it up so helpful like that. Again, possible contingent liabilities would be legal claims, lawsuits, or debt guarantees. If we have guaranteed the debt of somebody else, and if it looks like they might default, that could be another contingent liability. Okay, last slide. Okay, times interest earned. This is the ratio for the chapter. All right. The ratio for the chapter is time interest earned, okay? Now, interest expense, as you will learn, and you're probably already learning in your personal life, and you can come off the slide for a minute, okay? Interest expense and payment of debt is sort of a fixed expense, is it not? Let's say a company borrows a bunch of money and they have to pay a $1,500 payment each month in regards to that debt, okay? Well, if their sales are up, they have to pay that $1,500. What if their sales are down? They still have to pay that $1,500, right? It's not unlike if you buy a new car and you have a $300 car payment, the bank or whoever you owe that money to doesn't really care if you had a good month at work or a bad month at work or what. They want their money, right? Interest expense is kind of a fixed expense. We have to pay it regardless of our sales volume. Okay? Now that can be risky, can't it? That can be risky because if your earnings go down, you still have to pay those fixed costs. Okay? So going back to this slide, times interest earned is one of the measurements of how we are doing in that regard. Okay? How do we figure out times interest earned? Well, we take a numerator, income before interest and income tax. And sometimes that is called EBIT, earnings before interest and taxes. So that is usually not going to be the very bottom line of your income statement. That is usually going to be, up a few rows. You have to make sure that any interest expense or income tax expense is not yet deducted from that number. Okay? It's EBIT, not net income. And then we divide that by the interest expense. Okay? Now, as I always say with these ratios, do we want the ratio to be high or do we want it to be low, all things being equal? What do you think? High or low? I'll give you one more guess. High. Well, let me ask you this. Here's the way I ask. Would you rather have your interest expense be really high and your earnings before interest and income tax be low? That would give you a low ratio. Is that something you'd like? High interest expense, low income? No, that's not good. You'd like the numerator to be high and the interest expense to be low. So you'd like your ratio to be high, right? Now, I know I'm generalizing, I'm simplifying. But all things being equal, we would like to have this be high. I think your book states that if your times interest earned ratio starts getting below 2.0, below 1.5, that's very risky. That's very risky. Okay? Now, of course, you need to compare it to other competitors in the same industry, or compare it to previous period times interest earned ratios. You have to make sure you're making meaningful comparisons. But this is an important one. Okay? Just like in your own personal lives, as many people are finding out right now, right? When times were good and they had the great job at Sprint and they were getting bonuses every year and everything was going wonderfully, then the debt that they had on their 3 SUVs and their mortgage and their Branson home and their Wave Runners, they could make those debt payments and they were still pretty good shape, right? But now that somebody's been laid off or bonuses were withheld, do they still have to make those payments? Yes. And is it stressful? Yes. Okay. The economy is really going through this right now, isn't it? It's like time to party's up. Okay. That's what this ratio is talking about with businesses as well. Businesses can get in the same sort of problems almost always as people. They can assume that if in times that are good, that the good times will continue it forever. They borrow a lot of money, the economy goes south, and then they have all this debt they have to pay off. Correct? That's what this ratio is all about. Okay? Now before you leave, I think we have time to go ahead and go through exercise 11.1, which I assigned for today. So let's go ahead and do that. All right? Exercise 11.1. All right, the following items appear on the balance sheet of a company with a 2-month operating cycle. That's actually key, 2-month operating cycle, because the operating cycle is less than a year. Identify the proper classification of each item as follows. C if it's a current liability, L if it's a long-term liability, or N if it's not a liability. Now, since the operating cycle is only 2 months, the distinction we use is 1 year. If it's due within 1 year, it's a current liability. If it's due beyond that, it's a long-term liability. Okay, so let's go through these. Number 1, a note payable due in 120 days. What is it? Current. Number 2, a note payable due in 6 to 12 months. It's current. What about a note payable number 3 due in 13 to 24 months? Long term. What about accounts receivable? That's not a payable at all, is it? It's an asset, so it's in. FUTA taxes payable. What is that? Federal unemployment taxes. Is that current or long term? That's current. They want you to pay that soon. Notes payable that mature in 5 years. Long term. Number 7, current portion of long-term debt. That is current. We talked about that, didn't we? Salaries or sales tax payable, current. They want that right away. What about wages payable, number 9? Current. Salaries payable, also current. You're not going to mainly, your employees want to be paid too. So in summary, 1 was C, 2 was C, 3 was L, 4 was N, 5 was C, 6 was L, 7, 8, 9, and 10 were all C. Okay? So let me give you your last homework assignment. And we will go through these next period. And we will also talk a little bit about the final. All right? So we are done with lecture. The last thing that I want you to do is this assignment right here. They're all quick studies. Quick study 11.4, 11.7, 8, 9, and 10. All right? So we shall see you folks next time. We got one more, and then we will be done. Okay? Bye-bye.